Welcome to Second Take, the show that focuses on the issues behind the news. Gold miner AngloGold Ashanti this week released its second quarter financial results. Mining Weekly editor Martin Creamer tells us more. Welcome, Martin.
Thanks, Leandi.
Martin, AngloGold has indicated that it will be harvesting short-life gold mines for cash in light of the low gold price. What does this strategy entail, and why did the miner decide to go this route?
It sounds horrific. It sounds like a scorched earth policy or Custer's last stand. But what it means is that you don't put any more money into the mine. So what you see is what you get, and you extract what is accessible. So you've invested to get access. You take what is accessible, that's left of the ore body, you remove it entirely, and then you just leave that mine. So, it's a harvesting process which I think is like a last resort. You can come back and start investing in the future, but investment, always has to go hand in hand with mining, because you're always looking for new faces to mine, and you must have that flexibility. But what he's saying is that if things go, if it gets desperate, if we go below $1,000 an ounce, we will enter this harvesting phase, which is a fundamental change for the industry. It's like saying, if times really get bad, this is the worst scenario we can face, and this is what we will do. So he's like preparing the market for an eventual situation that hopefully doesn't come, but you can see he's already begun it in West Africa, in Mali. There are two operations there where the owners, and they are not the full owners, they've got 40% of one mine and 40% of the other. It's Sadiola and it's Yatela. They are partners with AngloGold, but the two of them have decided that they're going to harvest. They're going to move into harvest mode there already, even though the price hasn't fallen below $1,000 an ounce yet. Even with the existing gold price, they've decided this is the way to go, with those two small mines, and Marilla is mentioned as well. So it's where they are partners. They've decided they're going to harvest. But if the price falls below 1,000, he will then say, well, we've already got this model. We will extend it further to where we have to in order to survive this downturn. Because he's saying, for 40 and more plus months now, the gold price has been falling. And even though they are often saying, well, look, it's not expected to fall below a certain level, it does. So you've actually got to prepare for that. And this is the preparation. He's saying the next model, the next mode we can go into is harvesting. We're starting it in these two mines, the smallish mines, and where we are really not the full operator. But this is where it will begin to happen. So the model is already in play if we have to extend it further. And we notice that, he's saying that the times are tough in mining industry, but we rise to every tough occasion, and we also get tough. And this is a response that we've seen called harvesting.
And then, Martin, during the second quarter of the financial year, AngloGold's costs and production beat guidance. How did the company achieve this?
That's one thing about what AngloGold under this team that is led by Venkat. When they say they're going to do something, they normally announce their to-do list at a quarterly presentation. And then in those 3 months, they do it. And then they come back and they tell you how they've done it, and it's been done. And they give you another set of to-do lists. And this has been going on for months now. So they've got a lot of credibility from the market, because they don't ever not do what they say they're going to do. And we can see they had a fantastic deal. They sold one of their operations, and they're now telling the market, look, we're not going to sell anymore. We're going to go into joint ventures. But they did a very good deal. They sold off their North American mine in America, it's in the US, Cripple Creek and Victor, for a price that has surprised the market. They got $820 million for that. And this has been one of the reasons for this liquidity that they're in now, because they're getting that cash in. And they got it in ahead of the presentation of results, and they showed that liquidity. And a lot of their peers are saying, whoa, that was a good deal. How did you do this in that market? But I think it's probably the nature of Cripple Creek and Victor, because it's in North America, because it's in the US. It kindles the interests of US gold mining companies. They say, wow, we've got this in our backyard. yes, we're prepared to pay that, because there were several other bidders for this, because a lot of these miners don't want to go to the frontier necessarily. They don't want to go into areas where there are political problems. So going into the US was seen an advantage. They sold it off, and they kept a royalty. Now, which means that they still get a revenue stream. If the gold price lifts, they still get a percentage of those spoils coming from that mine that they used to own. So it's quite a good deal. You see that a lot of the deals done these days, they have that royalty clause, so that when things improve, they'll have a revenue stream from what they've disposed of.
And then, which of AngloGold's operations delivered standout performance during the second quarter?
This was also heartbreaking for South Africans, because we saw, the South Africans underperform. We saw international assets of AngloGold Ashanti do well. In the quarter, the earnings, the EBITDA in that quarter, the last quarter, those 3 months to June 30, 84% of those earnings before tax and amortization and depreciation came from outside of South Africa. We also noted that if you took into account all the currencies where they're operating, so you took into the weaknesses of the currencies in Brazil, in Argentina, in South Africa, in Australia, if you took those all into account, you found that they offset the gold price, which is quite an interesting position for AngloGold Ashanti to be in. So what they're saying, particularly during this period that there might be a strike, they're saying, we're not saying you mustn't go on strike. That's your decision, unions. All we're telling you is that 84% of our earnings this quarter came from outside the country, which means that we're quite resilient to a strike. So we're putting it into that context, that within reason, we can actually withstand a strike, depending, of course, how long it goes. But I don't think, the government and the industry can allow a strike to go on for 5 months like it did in the platinum sector, because you can see what's happened to the platinum sector. It's in a devastating state. So what they're saying is, you've got every right to go on strike. But if you do, just understand that 84% of our earnings are coming from outside the country now. So we can actually stand against you. We believe we're in the moral high ground. We've offered you, the best deal we can, plus that if you're still not prepared to take it, these are the facts. Let's put it into this context, that we can actually hang tough on this.
Okay, thank you so much, Martin.
It's a great pleasure, Leandi.
Thanks. That's it for today. Join us again next week for more news analysis on South Africa's mining industry.